a calamitous quarter. We spent the first half seeing the highest values we've ever seen in client portfolios, but we ended it with the Iran war, where stocks, bonds, gas prices, investor confidence all fell apart. I'm not going to recount the headlines, but I'm going to talk a little bit about how I see this playing out, what can change in the short run and what's going to take a little bit longer. And I dare say I could leave you with some optimism and around a silver lining we can find as investors if we think about this in terms of the opportunities it can present based on some of the bottlenecks that are occurring. Obviously, the biggest one is the Strait of Hormuz. The question of when and how it will open is unclear, but when it does, it's going to take a while to sweep it of minds and things like that. Even then, a lot of the oil and gas production has been stopped, and it takes a long time to restart an oil well. There's a lot of heat and processes and things that you have to delicately and slowly restart. A lot of the press is centered around oil. Oil is a fungible asset, and quite frankly, you can buy it somewhere else. There are other things that are harder to replace. For example, in the gas complex, you can see where they produce fertilizer, they produce helium, and some other more difficult to source byproducts of that process. That the Qatari gas fields supply over a quarter of the world's gas needs. So you could see some trouble getting those commodities replaced. The other issue with the gas fields is that a lot of electrical prices are geared to gas prices. So the United States, in 50 years ago, it took about 1 barrel of oil to produce $1,000 of GDP growth. We've managed to cut that in half. So now it takes half a barrel to produce $1,000 of GDP growth, which is great, but we haven't reduced the amount of energy we're using. We just switched it to the electrical side. So the problem you can see is if gas is driving electrical prices, and electrical prices are a bigger part of the US consumption basket, then we could have some very high electric prices in the medium term to go even when gas prices have gone back to normal. Now, the other issue, and this turns to the investment question, how we're going to invest this, centers around the fact that the AI theme has been a big driver of American financial markets and global financial markets. Now, the question centers around the electrical needs behind AI, the chips that drive artificial intelligence. If we can't secure the energy to run the centers or the raw materials to manufacture the chips, like helium, which is a byproduct of natural gas, then the AI thesis, it's not dead, but its arrival date could be delayed, which could affect valuations in the US. The American stock market has traded as if this is more of a buy the dip opportunity. It hasn't, even though we lost quite a bit on stocks last quarter, or the market lost a lot. We didn't lose as much, but the market lost a lot. It's still priced as if it's going to rebound relatively quickly. Now, the bond market is different. What's interesting in the bond market is if you look at the expected inflation in the bond market, which is the difference between treasury yields and inflation protected treasuries, both of those yields went up last quarter, meaning the bond market has also priced the inflation question as being transitory. Now, that may not come to pass, which makes an interesting trade in terms of possibly buying inflation hedged type securities, including the inflation protected treasuries. So that's one area that's interesting. Something else that's come up a lot last quarter, which is private credit. There's a shadow banking sector, private credit. These are loans that are given between private parties, meaning private individuals give it to companies that are not public. And there's a transparency issue, and there have been defaults. And there's a question about the extent to which the defaults will happen. Now, a lot of those loans were to software companies that are getting directly challenged by artificial intelligence. A lot of the software as a service and things like that are getting challenged by this question. So if those software companies default, you could see a lot of credit defaults, and it will be not very transparent. And so it could sort of come out of nowhere. So that's something we're watching. It's not really a big concern for investors right now, though. The other question is, in the longer term, centers around the dollar's position as a reserve currency. So the dollar was linked to the gold standard. Nixon took us off the gold standard. He sort of switched us to the oil standard. Most oil was priced in dollars per barrel. That's how you hear it, whether it's drilled in the North Sea or Texas or anywhere else in the world. But now, because of the strain on resources, you're seeing a challenge to the dollar's use in the trading of oil. So you could see oil priced in rubles, you could see it priced in rupee, all sorts of things that could challenge the dollar's position as a reserve currency. Why is the loss of reserve currency status a problem? It's a problem because when you have a reserve currency, you can run budget deficits. And the US has run budget deficits every year I can remember in my lifetime, except for 1 year under the Clinton administration where we actually had a budget surplus and we retired one of the bond issues, which is remarkable. But that's a whole different story. But if we don't have as many folks who want to lend us money, it's harder for us to run a deficit. Now, what that means is we can still borrow the money, but we're going to have to pay a much higher interest rate to get that money. So that's a theme that we want to look at, that with the amount of debt the US has, the servicing of the debt is our biggest expense. It costs us more than our military to pay interest on our debt. And so as that grows, it could start to mean that we are having to pay more in interest, and interest rates could rise, and you could see the impacts on the economy from that. So that's something that we are watching. We set up our portfolios to profit from this type of volatility. So the idea of asset classes implies a diversification where certain assets go up and certain assets go down, but the losses are lower than the gains we make. So as the market gyrates, our portfolios tend to collect profits, meaning we could show a 0% return, but a positive dollar amount. That's the way we engineer portfolios. So our portfolios were already set up to buffer this type of volatility, which is why we don't invest 100% in US stocks. So we've done a few things. We put forth a very strong initiative last quarter to rotate into some higher growth countries, to increase our international sleeve and to rotate into higher growth countries. We also took some fixed income and put it into gold to address this reserve currency question. And in doing that, those trades went up in value and then they came down, but they net made money, which meant they acted as a buffer to the global volatility. They certainly were able to preserve wealth. Now, we did a few other things as well. We have exposure to oil and gas, which also helped us. And additionally, we have some other, in our fixed income, we went very high up the credit spectrum, which is why we don't have private credit or even junk bonds. And we also started buying inflation protected treasuries and even some short treasuries, meaning we have some trades that short the treasury market. So all of those were players we had on the field to buffer losses. For portfolios and clients where we could do it, we actually executed our insurance trade last quarter. And once again, that quarter, that trade started to make a lot of money last quarter. And some of it was luck because we had two legs to the trade. We had a short trade and then we had a hedge trade. We pulled off the hedge trade, and that trade was making about a 40% return when we pulled it off. And then we later saw the other leg, which was short the S&P 500, also profit. And so those trades together were very, very profitable. What this means is that we are now in a great position to rebalance. The most difficult call I have to make is, when do we rebalance? In other words, I don't want to do it too soon, or we're going to have more money on the table when the market loses more, but I don't want to do it too late and miss the opportunity to buy some really cheap assets to capitalize on it. This year sounds, in my mind, a lot like 2020 and a lot like 2022, where we were able to rebalance at the bottom of some dips and really accelerate gains for our clients. So not only is our portfolio designed to make profits from this type of volatility, but when I get involved in rebalance portfolios, it turbocharges that growth, turning this into an opportunity as long as we can be patient and long-term oriented. So I want to thank you for working with me. I always joke that these are the times when I really have to earn my keep, or when I provide the most value to clients, because these are the times when it becomes a trader's market, and it becomes a market for people who have 30 and 40 years of experience the way I do. And so my hope and expectation is that we can carefully drive down a very clear path forward that's going to leave us better off than we started. So I want to thank you again for working with me. It's a real honor, and I hope that you and your family have a very joyous and wonderful holiday season and holy season. Thank you.